Okay, this is what we're going to try to do. We're going to try to explain the logic of the intercompany inventory transfer entry that we've been making in class. Try to explain why it works using a version of T account type of analysis. Not something easy to do at the spur of the moment because the total logic is let's stop that. Hold on a second. All right, what we're going to try to do is explain the logic of the journal entries we're making on inventory transfers between parent and subsidiary or vice versa, and see if we can understand why the entries work. This is a logic question and accounting, of course, but to follow the logic and the actual analysis of what's going on requires certainly a fair amount of thinking because it's pretty difficult accounting. So that's what we're going to try to do here. Let's do it this way first. Let's pretend that our facts are the following, that we've got intercompany sales going from parent to subsidiary. And the parent sold, let's do it the following way. Let's do it. The parent sold $200 worth of inventory. I'm sorry, $200 sales. The inventory is $100. So now, if we're doing a T account of where our consolidation will be, that's what we're going to try to do. We're going to have to follow 3 T accounts: sales, cost of goods sold, and inventory. These T accounts are the T accounts of what the consolidated statement would look like based on the combination of the accounts from the parent and subsidiary and any elimination entries that we do. So here we have a sale of $200 to the subsidiary, and this number here, this is sales. So now we would have in our T account sales of 200. And the subsidiary would have inventory of 200, because on the subsidiary's books, they're going to show a purchase of 200, which immediately goes to their inventory account. On the books and records of the parent, we have the $100 cost of goods sold, so that if we don't do anything else, that's showing up here in the T account of the consolidated company, $100 cost of goods sold. So far, we have sales of 200, cost of goods sold of 100, and inventory of 200 on the books of the consolidated if nothing else is done at this point. And so assuming there's been no sales by the subsidiary, they merely purchased this $200 of what was once $100 of inventory, our entry told us that what we do is we make the following entry. And I'm going to try to get fancy. I'm not sure it'll work. But let's see if I can get fancy. I'm working on it. I was looking for a different color. Let's see if that works. So if we make the entry that we were learning about in class, we would start off by, well, it's a little bit different of a color. We would start off by debiting the sales for the full amount. That's one thing we do. So we would put that debit here. And again, this what we're doing over here is following what the T account looks like for the consolidated statement. And then we would have credited cost of goods sold for initially just the 100 in our method, then figuring out how much inventory remained, what percentage of the inventory sold between the intercompanies sold, and we would have found that in this case, with nothing sold by the subsidiary, it's 100% didn't sell. So if 100% didn't sell, we make the balancing credit entry all to inventory because that's where the profit is embedded in the inventory. So let's see what this entry's done. Well, the first thing this entry did is it got rid of the sale, and that makes sense so that the sales for the consolidated company as a whole will now be 0 because there's been no sales of this inventory to the outside world. that's good. The second thing that happened is we wound up crediting cost of goods sold here, and that makes sense because if there's no sales, by logic, the cost of goods sold here should be 0. And that's what it would come out on a consolidated basis. And since the inventory amount that went on the books of the subsidiary was 200, remember the inventory on the parent was zeroed out through the entries on the parent's books of the intercompany sale. And so right now on the consolidated books, if we did nothing to the inventory of the subsidiary, the inventory's T account would have this 200 right here. And that inventory is fine in the sense that it's there, but it was really only originally worth this 100. So so this entry, bringing in a credit to inventory here, pulls this down to the real $100 value that it should be. Oh, a little messy, but I think it got the job done. The problem is now trying to show you the next example on this same page. Oh my goodness. Okay. Well, let's let's see what we have to do here. Let's wipe this. Let's see if we can just wipe this clean and start to the next page. Let's do it that way. Here we go. Okay. This is our last page, so that should be fun. All right, let's do the same thing. We have the parent, we have the sub, we've got our T accounts as they're going to appear or through the consolidation process. These are, again, consolidated T accounts for analysis purposes. And we've got inventory. And in this case, we're going to do the sales of 200, cost of goods sold to the parent 100. And this time, the subsidiary will pick them up as a purchase, sell them for 400. So sales on their books is 400, and their cost of goods sold is 200. Because that's their purchase here. And so they'll have recorded that way. At this point, what would have happened is we would have made an entry using our methodology, again, of first debiting sales for the 200 of the intercompany sales amount, crediting cost of goods sold for 100, and then figuring out what the balancing credit needs to be. Since all of it sold, the balancing credit, our little worksheet tells us, is to cost of goods sold for 100, and let's see why this works out when we get to the consolidated. Let's see how it works out. So before we do the analysis of what our journal entry did here, let's see what the consolidated T accounts would have looked like prior to that. Well, the sales, here's a sale, and here's a sale here. So the sales would have been recorded at 600. The cost of goods sold would have been recorded at 300 because it's a combination of the cost of goods sold from both the parent and the subsidiary. Here's the cost of goods sold on the parent's books, right there. Here's the cost of goods sold as it would have been recorded on the subsidiary's books. So we would have had 300 showing up here, and I keep having trouble making that 3. Okay. So let's try it again. 3, not much better. Even worse. All right, one more time. Cost of goods sold. I'm left-handed, that's the problem. 300. Now, the inventory at this point is 0 on the books of the subsidiary, of the consolidated T accounts. As you see here, the inventory is 0, and that's fine because the inventory is now, in this example, been sold to the outside world in total. And so our entry, notice our entry here, does not touch inventory, doesn't adjust inventory. But let's see what these entries, this elimination entry, does do to the T accounts of the consolidated groupings, if you want to call it that, and how it affects the bottom, the end result. We're going to debit sales for 200, and we're going to credit cost of goods sold for 200. And look how amazing this winds up to be, so that when we get to the consolidated, we wind up with $400 of sales showing, which represents the amount of sales sold to the outside world by the subsidiary here. That's the actual sale, because in this example, everything was sold by the subsidiary in 1 year, so the sales we should record is the 400. The cost of goods sold is now 100 after the adjusting entry here, and that makes our gross profit 300. That's our gross profit, and that's true to life because that's exactly what happened. We took 100 hours of cost of inventory, and we sold it eventually to the outside world for 400, all in 1 year. So the gross profit percentage or gross profit amount is really indeed 300. And so this entry that we made here, this elimination or adjusting entry, which we did according to formula, makes the books and records of the consolidated come out perfectly well. I'll pause there or stop there and come back to finish it up with the final example.